don't need to be rich to buy your first rental, but you do need to know what to expect. Because honestly, the fastest way to get discouraged is thinking that you're ready and you have all the money that you need, and then realizing that you missed a few of the major costs. If you've been following along in this video series, you already know your why, and we've already started learning about how real estate builds long-term wealth. Now I really want to get real about the money, what you actually need to get started, what's optional, and what's really, really smart to plan for. Hi, I'm Emily Duplessis, and I teach aspiring real estate investors how to buy their first rental property with confidence. All right, let's break down the myth you need to be rich. Goodness, this makes me so angry. Because the truth is, most first-time investors think you need $100,000 sitting around in your bank account, that you need to be rich to be able to buy that first rental property, and it is simply not true. But what you do need is a clear understanding of what the actual upfront costs are going to be, what things might be flexible, and what isn't flexible. And once you know that, then you can actually make a plan. And I feel like once you have a plan and you have a little bit of that confidence, all of the numbers start feeling a little less scary. So today I want to break down 4 different costs: your down payment, your closing costs, your reserves, and your hand money, or also called earnest money deposit. And I also will throw in there a few creative ways that new investors can use to make these numbers work if the traditional route is just not working. So let's break in to the biggest piece of the puzzle, and that is the down payment. If you're buying an investment property, and I'm talking investment property, not the primary house that you are going to live in, you are going to typically need anywhere from 15 to 25% down if you're using a traditional financing route. For a single family rental using conventional financing, it's usually 15 to 20%. If you're buying a multi-unit, you're looking at anywhere from 20 to 25%. So on a $200,000 property, you might be looking at anywhere from $30,000 to $40,000 for your down payment. But here's one of the things that some newbies miss. They might hear that number and go, oh my gosh, I can't do this. I can't afford this. I don't have $40,000 sitting around. But if you're willing to get creative, you can do it for less. There are some strategies, one of them house hacking, where you buy a small multifamily property. You live in one of the units, let's say it's a duplex, you live in one of the units and you rent out the other ones, and that allows you to qualify for owner-occupant financing. And that down payment drop goes from 15 to 20%, and you're dropping down to 3 to 5% of a down payment on something like that. Another strategy is to partner with someone who also brings maybe some of the down payment. You could, look at that same $40,000 down payment, bring in a partner, and each of you do 20 and 20. So there is the standard route, but there are options. You just need to kind of know what they are and really get a feel and an understanding of what they are so that you have confidence in making those decisions. All right, number 2 is the closing costs. These will usually run on average anywhere from 2 to 5% of the purchase price. And these include your lender fees, your title insurance, your appraisal, and anything else that is kind of required along the loan process. So if we're looking at a quick estimate of that on our $200,000 property, we're looking at about $5,000 to $10,000 in closing costs. Sometimes the seller can cover these. This is actually a strategy that we teach our newbie investors, and we teach inside our Zero to Property course. If you're in a negotiation process, one of the things that you can ask for is to have the seller pay for some of those closing costs so it's less money out of your pocket. And we dive more into that inside that course. But here's always my tip. You have to build your budget and run the analysis assuming that you are paying all of those closing costs yourself. If you get any kind of seller credit or discounts in that process, that's wonderful. That's icing on the cake. But I always recommend that you assume that you're paying all of that. All right, the last one is our reserves, or also called our hand money. And this is one that actually gets overlooked and missed by not just investors, but just people who might be a first-time home buyer. This is money that you keep kept aside that your... All right, let's jump into reserves. This is, if I could shout it from the rooftop, one of the most important things that I like to stress to newbie investors. And this is having reserves. This is money that you have kept aside after closing just in case. Now, with traditional financing, a lot of times banks and lenders will require you to have 3 to 6 months of this. But if you're using a different type of loan product and they don't require it, I recommend it very, very much, because this is your money that you go to whenever you have a vacant unit, or your furnace dies, or the dishwasher falls apart, or there's a leak. Those are incidents that will happen. And I don't say it to scare newbie investors, but the reality of investing in rental property is that you are going to have things that are going to happen. And I can promise you that when you have the money in reserves to help cover that, it is far less stressful. We were in the middle of a renovation on a vacation rental in a beach town, and we were simply replacing the deck. And when they went in to replace the deck, so much of the house on that side had been rotted just from being right on the ocean that the whole back of the house almost fell off and the whole house shifted. Now, that was totally unexpected. And thank the Lord that we had reserves that helped us in a renovation that ended up being far more intense and costed way more money than we ever expected when we started with just the simple deck project. So again, I can't stress it enough. Having reserves will literally save you so much stress and so much headaches. And in fact, I recommend that you don't buy rental property unless you have reserves. All right, number 4 is the hand money, or also known as your earnest money deposit. And this is one of those items that is often overlooked by first-time investors, but actually, honestly, just by first-time home buyers. And I hear this from a lot of agent friends that I have that say, people just don't understand what this is. So this is a deposit that you put down to show the seller that you're really serious about making your offer. So when you put together your offer and you're working with your agent and you submit that, you are going to offer 1 to 2% of the purchase price with that offer, saying, I'm going to give you this deposit because I am a serious buyer and I'm seriously interested in this. And that money is going to be held throughout this process, throughout the entire process of buying this property. And then it will be used that money will go toward your sale and the closing once the deal goes through. But you have to have that money up front, and that's the kicker. So if we're still looking at that $200,000 property that we've been using as our example, you might have to put down anywhere from $2,000 to $4,000 up front. So you want to make sure that you account for that, because that's one of those that really trips up first-time, like I said, investors and even just first-time home buyers, because it is due right when you go under contract. So it's really smart to make sure that you have that set aside also when you're going after that first rental property. So if we take all of the information that I'm saying, we put it all together, let's still look at our $200,000 property, right? That's the rental that we want to go after. If we're looking at our down payment, 20% down, we're looking at about $40,000. If we're looking at 3% closing costs, we're at $6,000. And if we're looking at our earnest money or our hand money, we're at about $3,000. We want to make sure that we have those reserves. That you should have about $6,000. So when we take all of that and we put it together, we're looking at about $55,000 total that I would say you would comfortably need to go after that property. Now, obviously, can you get started for less? Yes, absolutely. That's why I gave you some of those ideas about house hacking or having a partner, or maybe even just finding a lower price market and properties that, cost maybe half of that or 2/3 of that. But the point is, once you know what the pieces are, that the pieces of what you need to have when it comes to financing and buying that first property, you can actually make an intentional plan to get there. So the long and the short is, you don't need to be rich. You just need to have a roadmap. Because once you understand, where your money's going and what's expected of you as a buyer and as an investor, you can really kind of stop spinning your wheels and allow yourself to maybe get creative if you can't quite do it all on your own or the traditional route. So thanks again for tuning into this. Stay tuned, because in video 4, I'm going to be breaking down all about finding markets. This is maybe my favorite thing to teach and to share on, is becoming a student of your market. It's a huge piece of the puzzle, and I will tell you that it's one of the things that's going to bring the most confidence to you as an investor. So stay tuned.